right, thank you. So can everybody hear me in the back? I think I have a pretty big voice, but if you can't, please raise your hand and tell me. I also don't want this to be a lecture today. So if you have any questions, comments, if you want to yell stuff out, I'm good with that. I promise it's not going to hurt my feelings. And we are going to talk a little bit differently about long-term care. So before I always get started, I always ask the room, what's the first thing that you think of when you hear long-term care? Chill it out. Facilities. What else? Expensive. Anybody been a caregiver? Raise your hand. Okay, a few of you. Anybody willing to say if their family member had a plan or not? Was it reactively?
No plan.
No plan. Well, today we're going to talk about some ways that we can mitigate that risk, and hopefully you'll be able to take a few nuggets away from you today. So with that being said, again, we're going to talk a little bit differently about long-term care. The first thing we're going to talk about today is some of the misconceptions when it comes to long-term care. The first myth or misconception is, it won't happen to me. So raise your hand if you think you're going to need some type of care. Okay, usually it's the women in the room, and typically in a room this size, you guys think that you all over here are at a much greater risk, but really, there's a very good risk that you're going to need some type of long-term care, and we'll talk about that here in a few minutes. Our next misconception is, Medicare or Medicaid have me covered. So how many people think the government's going to take care of us? So I usually get a pretty good chuckle out of that. So there's a lot of common misconceptions when it comes to Medicare and Medicaid. For example, Medicare, you have to be hospitalized at least 3 days. You have to be rehabilitating or getting better. And typically it covers up to 100 days of skilled care. So really it's short-term care, not long-term care. Anybody know how Medicaid works? So Medicaid is means tested, meaning you have to be impoverished in order to qualify for Medicaid benefits. Medicaid is a great program for those that need it, but I wouldn't voluntarily give up my money to be placed into a Medicaid facility. Typically, Medicaid does not cover care in the home, and I don't know about you, but I'd rather not go into a facility and receive care. So again, a lot of common misconceptions when it comes to Medicare and Medicaid. Our next misconception is, that's what my savings are for. So long-term care is very expensive. If you're taking notes, there's a fantastic website. It's longtermcare.gov. It has a lot of great general information. For example, what type of care services are available, who needs care, how long you might need it. But then there is a great link that will redirect you to the Genworth Cost of Care Survey. So on this website, you can type in any city or zip code in the country, and it will pull up the local cost. And again, long-term care is expensive, and what most people don't understand is that if you don't have a plan, your money is your plan. So as an example, I pulled up the local cost. I think the closest area here is Winston-Salem. So the 2024 numbers are $57.20 a month for home health care. They're running around $6,400 for assisted living and around $11,000 a month for nursing home. And again, these are averages. So what you're looking at here are probably the Medicare numbers, which are about 20% less than private pay. And again, it's expensive. And for those of you that don't know what round-the-clock home care costs, right now it's running around $15,000 a month. So again, it's pretty pricey. And y'all are all young. You might not need care for 10, 15, 20 years, right? So what is care going to cost when you need it? There's a little slide you can project out future costs, because we know what's going on, right? There's a lot of inflation. So as an example, I pushed out the numbers for 20 years out. So now we're looking at, for nursing home, $20,000 a month. We're looking at assisted living around $11,500 a month. And for home health care, now we're looking at around $10,000 a month. So again, long-term care is expensive. And what most people don't understand is that if you don't have a plan, your money is your plan. So let's talk about our next misconception. My family will take care of me. And I say this jokingly, does your family know that? How many of you have adult kids that don't live close to you? Okay, there's a few of you. So take my family, for example. I'm the oldest daughter. My mother's been twice widowed. She's 80 years old. My stepdad passed away at the beginning of the pandemic from a short illness. I have an older brother who's 10 minutes away. I have a sister who's in Western North Carolina, and I have a brother in Hilton Head. I'm an hour and 15 minutes one way. About a year ago, maybe more, Mom got sick. I went down to Mom's every day for 2 weeks to make sure she had medicine, to make sure she had food, to make sure that she was okay. I love my mother, right? That's what I'm going to do. Ask me how many times my older brother, who was 10 minutes away, went to go see Mom. Zero. You guys are real smart. Now, I love my brother. If he was in the front row, he might throw a water bottle at me, but he is not a caregiver. And he does have a valid excuse. His wife's mom does live with them, and she requires round-the-clock care. They can't go to the grocery store without having, by the way, my mother, who's 80, go over and sit with her because she's a fall risk, and she really needs someone to watch her full time. So he does have a little bit, again, of an excuse. But what is that going to look like when my mom actually needs care? I have twin boys. They're 17 years old. They're about to graduate from high school. I travel all across the country doing these events. What stage of life am I going to be in? Long-term care doesn't bring families together. It tears families apart. And we'll talk a little bit more about that in a few minutes. But what's it going to look like when I'm sitting around the Christmas table or the Thanksgiving table when I'm taking care of Mom, right? You think I'm going to be a little resentful that maybe my brother's not helping? Or maybe my little brother is telling me what to do with Mom's money? And my stepsister, I don't blame her if she doesn't want to take care of my mom. She has her own mom. So again, long-term care doesn't bring families together. It tears families apart. All right, so what's the goal when climbing a mountain? Anybody? Most people would say to get to the top. It's actually getting down that mountain successfully without breaking our neck and without breaking our back. So a lot of baby boomers have gone through what we call the accumulation phase. They've saved and saved and saved. And now we're seeing people retire, right? What happens when you retire? You're going back down the mountain. You're hearing a lot about retirement income and retirement income planning. So what would be some of the issues during that descent when you're going back down the mountain? How about having enough retirement income? We're living longer. Are we going to outlive our assets? How about market volatility? We're not seeing any of that lately, are we? How about healthcare cost? And two that I don't have on here is, number one is inflation. How about taxes? Are taxes going down? Probably not. But more specifically, an income stream to pay for care. All right, so in your retirement years, what would be the reason that your income needs would suddenly skyrocket? Let's say you're living well on $100,000 a year and all of a sudden you have to take an additional $70,000 on top of that. What would cause that to happen? So most would say some kind of health issue, right? Maybe you or your spouse, if you're married, become frail and need some type of care. Where would you, in that example, get that additional $70,000 a year? So when your income needs suddenly skyrocket, where do you get the income to fill the gap? So which asset would you liquidate first to pay for care? So most people are going to liquidate conservative assets, like money sitting in the bank. Two major types of long-term care solutions. There are lots of other kinds, but there are two main types I'm going to talk about today. Traditional long-term care and asset-based long-term care. Anybody familiar with traditional long-term care insurance? So I'm going to use an analogy. Traditional long-term care is like renting. It's the cheapest way to buy the most amount of long-term care. However, just like homeowners or car insurance, rates can go up. Also, if you die and don't use it, there's no death benefit. And there's no exit strategy. Whereas you have another solution called asset-based long-term care, that's like owning your policy. You have a benefit whether you live, whether you quit, or whether you die. So here's a concept of what asset-based long-term care might look like. So the government has allowed certain life insurance or annuities to be accessed while alive, tax-free for long-term care expenses. So if this was your portfolio, most people have conservative, aggressive, and moderate assets. And again, if you liquidate money to pay for care, typically it's the conservative assets first. So potentially, we could reposition assets or income into a life policy or annuity policy that you can utilize tax-free for care. But it's still an asset on the balance sheet. But if you live and need care, you have pennies on the dollar leverage for long-term care expenses. If you die and don't need long-term care, there's a death benefit in the form of a life insurance policy or an annuity policy. Again, owning your policy versus renting it. So how do we fund an asset-based long-term care plan? There's really 4 ways that we can fund a plan. The first way is highly appreciated non-qualified annuities. I like to call it dead assets or rainy day funds. If you're not utilizing it for income, it's a great way to fund a plan. The second way is cash or cash equivalent. So money sitting in CDs, checking accounts, mutual funds, things like that. The third way is qualified dollars. So a lot of us have disproportionate amount of money in IRAs and 401ks, things like that. We can actually utilize those in a more tax-efficient way to pay for care. And then last but not least, income. So not everybody's in a position of repositioning a lump sum. And from a cash flow perspective, you can pay for these over time. So anywhere typically from over 5 years, meaning at the end of the 5 years you're finished, all the way to a paid to age 100. The longer you could stretch those payments out, the less from a cash flow perspective your premiums are. So let's take a look at some case studies. This is typically where I receive the most questions. Please feel free to interrupt me at any time. Our first example is highly appreciated non-qualified annuities. So here we have a 70-year-old couple. They have an existing non-qualified annuity. Does anybody know what happens when you take money out of a non-qualified annuity? You have to pay taxes on the gains. So let's say, for example, you have a $50,000 annuity. It grows to $100,000. So in its existing contract, when they take money out, they have to pay taxes on that $50,000 gain. In this solution, we can move that money from our left pocket to our right pocket through a 1035 exchange, which is tax-free. And every dime that comes out, so this is $150,000. So every dime that comes out for home care, assisted living, nursing home, adult daycare, hospice will come out tax-free. And there's going to be pennies on the dollar leverage for care. So the way that it works is that $150,000 day one turns into $450,000 for long-term care benefits. So every dollar, $3 of care. Think of that $450,000 as a tax-free long-term care bank account. The way that it works is they can take up to around $5,000 a month until that $450,000 is gone. If you do the math, that's 7.5 years shared between the couple. So if both people are using the benefits, it would draw the long-term care bank account down twice as fast. And as the annuity grows, so does the long-term care benefit. So if it grows, for example, from $150,000 to $200,000, that benefit is now $600,000 for long-term care purposes. Does that make sense so far? So every dollar they put in turns turns into $3 per care. So day one, that $150,000 turns into $450,000 just by moving it from company A to company B. Does that make sense?
But then it can only be used.
It can be used for other purposes, but the main purpose, this is an investment, right? We're not buying it for the accumulation. There's no sexy income riders on here, right? You're buying it for the long-term care benefit. You might make more money in another annuity. This is really for long-term care. Think about it like this. If you're 70 years old, how long do you think it would take you to earn to get to $450,000? You're probably not going to live long enough to do that. So by giving up a little bit of interest, you're getting the long-term care leverage. And then if you don't use it, that annuity will pass on to the beneficiary, just like any other annuity would. So what you're doing is it's a more tax-efficient way to utilize an existing annuity for long-term care purposes. Does that make a little bit more sense? Yes, sir.
Explain a little about, if you took this example and you rolled that 150 from one product to another to get that 450,000 coverage. If you get 10 years down the road, 15 years down the road, does the individual have the opportunity to go back in and just pull the cash out if they decide they don't want it anymore?
100%. So all of these solutions I'm sharing with you today have a benefit whether you live, whether you quit, or whether you die. So what he's referring to is the exit strategy, as I like to call it. You can take some or all of your money out, depending on when you change your mind. Most of the contracts call that a surrender value. And this one, as an example, it's a 9-year decreasing surrender. So depending on the interest that you earn, typically you're made whole in about 3 to 4 years, but you're really buying this, again, to put it in your lockbox, use it if you need it. If you change your mind, you can get it back. But you're really buying this for the LTC leverage. And if you don't use it, you don't lose it. So that annuity, whatever it's grown to, will go to the beneficiaries. And the way that it works is if you do need care, it comes out of your money. But what you're doing is you're getting it more tax efficiently. Because if you don't have a plan, your money is your plan. So this is a more tax efficient way to use your money, plus you have that additional leverage for care. If you take your money out, what are the tax implications? Just like any annuity out there, if you take money out of a non-qualified annuity, you have to pay taxes on the gains. Same thing here. If you take your money out, you change your mind, you want to go to Vegas and spend all your money, then you're going to pay taxes. For example, if it was $100,000 going in and it's $150 going out, you're going to pay taxes on that $50,000 gain. Great question. Any other questions on this one? Perfect. Before I move on, I'm sure you want to know how we utilize this if we need care. So the way that all of these solutions work is if you can't perform 2 of 6 activities of daily living, so everyday stuff, right? Bathing, dressing, toileting, transferring, eating, and continence. If you can't do 2 of 6, or you have a cognitive impairment, and this is your doctor certifying this, the policy will pay. There is what's called an elimination on most policies. That's kind of like the deductible. Like homeowners or car insurance, you have a $5,000 or a $500, $1,000, whatever your deductible might be. The way that this elimination or deductible works is if you need care with this solution, you have to satisfy a 90-day wait in a facility, meaning you pay out of pocket the first 90 days, or if it's home care, there's a 0-day wait. You can access that money immediately, and they'll give you up to the $5,000 until your pool of money is gone. Does that make sense? Yes, ma'am.
I'm sorry, I'm just backtracking a little
That's
bit.
okay.
If you don't have an annuity, you cannot use this, right?
You can stroke a check for this too, but if you have an old annuity and you don't have a long-term care plan in place, this is a great way to utilize that old annuity. So if, for example, you're not turning it on for income, you could stroke a check for $150,000 and get the same exact benefits. This is just a way to utilize existing annuity money if you don't need it. The other thing that you can do too, which is important, is if you have an old life insurance policy. You know, a lot of us buy life insurance when we're younger, if we have kids especially, because if we prematurely die, we want to make sure our family's taken care of. Well, let's say you've had this policy for 20, 30 years, and it's built cash value. You can 1035 that money into these policies as well. And you can use one person's money to fund both lives. So again, a great way to utilize that existing annuity or existing life insurance policy for a long-term care benefit. Yes, sir?
Is there an age limitation when you can invest in these policies?
That's a great question. So this particular solution goes to age 80. We have solutions that go to age 87. The annuities will go to 87. The life insurance, which I'm getting ready to cover, goes to age 80. Great question.
So if you're 85 and you have a pre-existing condition,
That doesn't necessarily mean you can't. So the way that underwriting works is every solution is different out there. So for example, you have diabetes. 5 different carriers may look at diabetes 5 different ways. Same with even more severe conditions. For example, this one, you can have cancer, be receiving treatment, and you can still get it. So don't think if you have health issues, you're uninsurable. There really is a solution for just about everyone out there. They even have guaranteed issue solutions. So that's a great question. Any other before I move on to the next case? Yes, sir.
If you've had a long-term care policy,
Yes, sir.
say for 10 years, and you wanted to change over to what you're talking about, can you get your money you paid out for 10 years and convert it?
It depends on what type of policy you have. We can review that. If it doesn't accumulate cash value, like for example, traditional, then you unfortunately, you can't get your money back. If it's a life insurance policy or something like that, then you can 1035 that money. But what I would say is it's hard to replace those policies. What we typically do is we look at them. We look to see, number one, is it cost effective? Number two, how much of a benefit does it pay for? Sometimes we layer on top of those policies to give you a more robust benefit, because cost of care can change and so can your plan. But I would encourage you to take that and let us look at it, just to see what kind of policy you have, to see if there's any type of transfer availability for your solution. That's a good question. Any other questions there? All right, so we'll move along to our next case study. This is cash or cash equivalent. So here we have a 60-year-old couple. I like to call this a timeline. It looks very similar to my concept that I showed you on asset-based long-term care. So 60-year-old couple, they have $200,000 sitting in a CD. They don't have a long-term care plan in place. They don't need to utilize this money for income. So we're going to reposition that into a life policy that will cover long-term care benefits. So the base policy, think of this as a timeline, is nothing more than a life insurance contract. If you need care, you can access the death benefit tax-free for long-term care benefits. Then we're going to add a rider that's going to give us a lifetime of long-term care benefits. So the way that it works is that $200,000 goes into the life insurance policy and the LTC rider. If they need care, it's going to generate, okay, so that's going to give them around $104,000 a year per person, tax-free for long-term care expenses. Now it's going to pay out on a monthly benefit, but I wanted to show you the significance of the lifetime income stream that it's going to pay for home health care, for nursing home, for hospice, adult daycare, etc., assisted living facility. So $200,000 goes in if they need care, around $104,000 a year per person. If both people need care, it's going to give them around $208,000 per person. And if their care lasts for 5 years, 10 years, 15 plus years, that's going to cover them as long as they live and need assistance. So this is true longevity, in my opinion, longevity benefits. You can't outlive this lifetime benefit. Now you can have any variation under the sun. That's the good news and the bad news. So you can have a 2-year benefit, a 4-year, an 8-year, a lifetime. But this is true longevity protection here. Now, it would take 52% guaranteed return of your money if you had to receive a lifetime income of around $104,000 a year. Anybody know who can do that? Can you guys do that? Can you sign me up? Most people understand they probably can't do that. So again, this is a way to leverage their money from the insurance company's pocket. Live and need care, they have a long-term care benefit. Now guess what? If they wake up an angel and never need any care, there's a death benefit of $208,000. So it's just barely over what they put into it, but if they die and don't use it, somebody's going to get those premiums back. Does that make sense? So live and need care, you have the leverage, more tax efficiently. Die and don't need care, you have a death benefit. If you want to quit, just like most life insurance policies that accumulate cash value, you have an exit strategy. You can take some or all of your money back depending on when you change your mind. Any questions on this solution? All right.
And this can be on top of a policy you already have.
Absolutely, yes ma'am. We see that a lot. Sometimes people buy, it's called layering, or that's what I call it. Some people buy policies when they're younger and maybe it's not enough, or maybe they have additional assets they can put into a plan. And this is a great way to supplement that other policy. And then if you don't need this, your family or whomever your beneficiary or favorite charity is will get the death benefit if you don't utilize it. Again, a lot of people love these solutions because of they're owning the policy versus renting it. Not that renting is bad. Traditional policies are great, but you have a little bit more risk associated with those because if you don't use it, there's no benefit.
Alicia, how's the coordination between Company A and Company B in that scenario work?
None.
You have a $5,000 benefit with Company A, and you purchase an additional $2,500 with Company B. How does that coordinate in order to be able to use the benefit? Do you have to use all of the $5,000 through Company A before you tap B?
Great question. So they do not coordinate benefits on these policies. So you could theoretically, if your benefit was $5,000, you were paying $5,000 for someone to come in the home, you could, in that example, you could get that additional $2,500 tax-free as well. So there's no coordination of benefits.
So that's an extra benefit.
It's an extra
by
benefit.
stacking on the second and on top of it for any shortfall.
You got it. It's called tax-free income for long-term care. Great question. Thank you for bringing that up. Any other additional questions on this?
Okay, I'm sorry, but which policy would pay first if you didn't need both policies?
You can choose.
You can choose.
Yeah, so in that case, I would use the traditional first because you can't get your money back, right? And then if you need to tap into that second policy, you can. Or if you don't think you're going to need longevity protection, you could tap into both and just have that extra income, tax-free. Great question. Any other questions on this one? All right. All right, our next hypothetical, oops, I had already moved it. Qualified dollars. So I'm going to say this real loud for everybody in the back. You are never going to get out of paying Uncle Sam, right? You're always going to have to pay taxes on qualified dollars. Everybody know what a required minimum distribution is? So we don't have to take those distributions out until, I think it's, what is it, 73 now? 73? However, in my opinion, taxes are on sale. So I'm going to show you a way to utilize your qualified money, pay taxes while they're on sale, and leverage tax-free for long-term care benefits. So here we have a couple who's 70 and 71. Now, when I originally did this example, I think 72 was the RMD age. Maybe it was even younger, I don't remember. But essentially what we're doing here is if we have a disproportionate amount of money in qualified funds, we can move that money from our left pocket to our right pocket. There's no, you don't have to pay taxes on that transfer. It's a tax-free transfer. When you move that money into this solution, you're going to get a 25% bonus on your money. So that $200,000 is going to turn into $250,000. I like to call this the McDonald's Happy Meal of long-term care solutions, because it's all done for you. All you're doing is moving the money. They're going to give you a bonus. Then they're going to turn an income rider on to fund a 10-pay life insurance policy. Those distributions are taxable distributions. Again, we're not going to get out of paying Uncle Sam. But what we're doing is we're spreading the tax liability out over 10 years. It's kind of like a Roth conversion. Y'all know what that is? So it's a Roth conversion for long-term care purposes. So again, each year, that $25,000 distribution is taxable. So what does that $25,000 buy? That $25,000 is going to buy them each $63,000 roughly a year for long-term care purposes. Now that is a tax-free benefit. So let's say, God forbid, a year from now, Mr. or Mrs. Jones has a stroke and needs care. That long-term care benefit is going to start paying out immediately that $60,000 a year on a monthly basis for long-term care purposes. All of it comes out tax-free. If both people need care, now we're talking $127,000 of lifetime income stream to pay for care. So again, you're turning your taxable dollars into tax-free for long-term care benefits. And when you do need RMDs, that $25,000 distribution will count towards an RMD, which is great. A lot of people don't want to take that money out, but the government doesn't care. They're going to get their piece of the pie. So this is a great way to satisfy that RMD. You're turning your taxable dollars into tax-free for care. And if you wake up an angel and you never need any care, there's a tax-free death benefit. In this example, it's $177,000. Is that as much as they put into the policy? Nope. Anybody know what happens to that $200,000 IRA if they pass it to their kids? They get to pay the taxes on that money. So you're giving your kids or your beneficiary the gift of paying the taxes for them. Make sense? Again, this is kind of like the McDonald's Happy Meal. You can buy your hamburger, fries, and drink separately. This is a solution where you transfer the money, you put it in your lockbox, hope you never use it. If you do, you pull it out, you've got a long-term care benefit. If you don't, somebody's going to get a death benefit. It also has an exit strategy as well. You can take some or all of your money back depending on when you change your mind. This is not what you want to do, but you have the ability, in case of an emergency, to utilize some of that cash.
What is this called that we're transferring it to?
So it's an IRA. It's literally going from a qualified account, so whether it's currently in an IRA or a 401k or a 403b, you're transferring it into an IRA, and they're going to turn an income rider on to fund the life insurance policy. That's why I call it the McDonald's Happy Meal, because it's all packaged in one. That's a good question.
In regards to the taxes on the $25,000 a year in this example, that would have to be paid out of pocket.
Correct.
You're withholding it from the $25,000 that you're actually pulling out of income to pay for free.
They don't do any tax withholding. If they take tax withholding out, it's going to reduce your benefit.
Right.
So they're going to pay the $25,000 and send you a bill at the end of the year. Well, 1099. It's basically a bill. Make sense? So don't get caught up in all the moving parts. I just want you to understand today, folks, that there's a lot of ways to fund these plans. There really is 101 different ways to do it. That is the good news and that's the bad news, but that's why these guys work with my team to do the heavy lifting. Because 10 of you could have 10 different solutions. And these aren't the end all be all, right? There's life insurance for chronic illness riders, annuities with income doublers. There's short-term care plans. There's a number of different ways that you can fund long-term care expenses. These are just some of the most popular. And I just want you to understand that you can use any asset under the sun to fund these. Does that make sense? Excellent. All right, any additional questions before I go on to our last case study? Great questions, everyone. Thank you for asking. Okay, so last but not least, income. So again, as I mentioned, from a cash flow perspective, you can stretch these anywhere from 5 years to a paid to age 100. The longer you spread them out, the lower the premiums are. Here we have a 62-year-old female. She's probably going to retire in 10 years. She doesn't have a long-term care plan in place. She doesn't want to rent, as I like to call it. So we're going to put $14,172 a year in for 10 years. Those premiums are guaranteed. So unlike the traditional, the renting, they can never raise those rates. Unfortunately, on the traditional side of the house, now I'm not seeing these large increases on the new policies, but on the old policies, I've seen these rates go up anywhere over 200%. So this is an alternative to guarantee your premiums. Oh, sorry about that. So $14,000 a year in for 10 years. So what does that buy the 62-year-old? It's going to give her around $6,000 or $6,000 a month for 6 years, or $72,000. Now, we put 3% compound inflation on that. She's young, she may not need care for 20, 30 years, right? So that inflation is going to help increase that benefit over time to keep up with the cost of care. I think, and don't quote me on this, I think it's 24 years if you have 3% compound on there to double. So in that case, now your $6,000 is going to be $12,000 a month. Does that make sense? For the living benefit, so live and need care, if she needs care, $6,000 a month for 6 years. So not a lifetime benefit, but a 6-year. If she dies and doesn't need long-term care, we have a death benefit of $144,000. So someone is essentially getting her money back if she dies and doesn't use it. And just like the other life insurance policies associated with these plans, you can take some or all of your money back because it does accumulate cash. Now, again, that's not the purpose of these. These are long-term care first, the life insurance is secondary. But it's a great way to utilize a life policy if you need it for care, and if you don't, someone's going to still come out ahead because we gets rid of that objection. If you don't use it, you lose it. Make sense? Now, from a cash flow perspective, if we wanted to stretch these out, for example, to a pay date, a 20 pay or a pay date 100, those premiums will go down significantly because we're stretching it out over time. All right. So what's next? So I always encourage you, even if you have a plan, schedule an appointment, review your plan. If you don't have a plan, start thinking about some of the options that are out there. Again, these aren't the end-all be-all, but at least look into it. If you decide not to put a plan in place, here is my encouragement or my nugget that I want you to walk away with today. Have a written plan of care for your family. Why? Because they don't know who you want to take care of them. They don't know where you want to receive your care. This will avoid a lot of unintended consequences if they know exactly what your care wishes are. So make sure if you do that, to complete that plan and give it to your family. If you have an insurance contract like one of the ones we discussed, make sure they know about that as well. And make sure they know exactly how you want to utilize that plan. Because some of these plans just send you a check and you don't want your kids taking out backhoes and yachts, right? Kidding. But really, that's probably the one nugget I want you to walk away with today. Tell your loved ones, and whatever you do it now. You've never been younger and healthier than you are today. And with that said, I'll open it up for any other questions that you might have. And I'll stick around for a few minutes, and I'm happy to answer any offline.
I'll jump in and I'll tell you kind of some of the feedback that we get with all these strategies. Now you understand why we use Alicia as our contact. There's so many different ways to basically put this together. There's no one solution. Everybody in here is different. Me personally, I did the hybrid life insurance approach because I wanted all three options. I wanted death benefit, long-term care, or if I wanted to, I'd get my money back. So I wanted all three options wrapped in one. Well, fortunately, I did mine when I was about 39 or 40 years old, so it wasn't that expensive at all. But it doesn't matter. If you have to have care, it's going to be more than worth your while to go through this. And I was impressed at how many people have something in place, but the review that she was mentioning, that's what we constantly need to focus on. We need to make sure that we're reviewing the current policies that you've got, and you've got enough in place to basically take care of those expenses that she discussed earlier too.
Any other general questions?
On the point on the doctor deal is that a lot of some people are saying they have an experience of, hey, my parent or grandparent had this and they never paid out, and it was just a big waste of money, right? So I mean, there's tons and tons of these policies out here. They work differently. So again, they're not all policies aren't created equal, right? So they're going to be functioning a little different depending on what you need and what you want to put in place. But a big part of what we look at too is that we want your doctor to make the decision that you can't do 2 of those 6 activities of daily living or whatnot, not the insurance company's doctor, right? I mean, like see some conflict of interest there, right? So there's some out there that's like the insurance companies. People come out and evaluate, like, no, they're good. So these are the different things that we kind of look under the hood under this, and use Alicia's group and to figure out how these things are structured. But you want to know what you got and how you can activate it.
And even if you have a policy or don't have a policy, a written plan of care plus your policy should be given to a healthcare power of attorney or someone who can make sure that your plan will be facilitated when the care need arises. Thank you, because it is really, really important. I've seen family members go through the entire claim process through a long-term care event and they didn't even know mom or dad had a policy. Right? You want to make sure our kids know, or whoever's going to be taking care of us.
The other thing that I'll say with some of the hybrid policies that we work with, Brandon and I within the financial plan, we will look at anywhere from 0.5% to 1% of your investable assets to judge for you what we feel is affordable. And if we can use 0.5% to 1% of your investable assets to fund this strategy, remember the income gap that she gave a description of? We can fill that, the majority of that gap, with less than 1% of your investable assets. That's the key. We can't do that any other way. The only way to do it is to make sure you're proactive and get this in place.
It's like an umbrella plan for all of your other assets. So you're just carving off a small portion to protect the other part where you can have fun with it, for income, for things like that, for accumulation. This is just a way to protect all of the other assets. It's income protection plan. And typically, too, I'll add, is you don't have to cover 100% of the risk. Like, you all will have Social Security. You'll have all kinds of things.
And we don't cover 100% of the risk. Why don't we cover 100% of the risk? Because we supplement it. And Alicia told me to look at it that way.
Yeah.
So that's why we do it. So we're concentrating on at least $4,000 to $5,000 a month in benefit because we know there's pensions. We know there's Social Security benefits that are coming in. Those are going to continue to be paid even if you're on a long-term care benefit. So we can fill the gap with some of that pension-related income that's coming in. So we don't forget about that. That's important. We don't want to over-insure, and I don't think you can, honestly, but we don't want you to pay too much. We want to make sure that we're utilizing that 0.5% to maybe 1% of your investable assets, and that's it. We don't want to use any more than that. Now, if you want to do a lump sum strategy like she's talking about, that's great too. And honestly, over a long period of time, it's the cheapest way to go.
how's the best way to make an appointment? With them, or do we
with,
call you directly?
with us, and then we get with her. Yeah. Brandon and I will do the analysis. Andrew and Scott will actually take care of the paperwork and questions and everything. So they will go through that whole process. It's a very labor-intensive process, which is fine. That's part of it. But we stay proactive so we can push it through. Yeah, you might see a 6 to as much as a 12-week period of time before we get an approval or something that we work with to get it to the point where we think it's a good plan for you. But we will constantly work through it and make sure we get everything pushed through from a medical underwriting, everything that's required from that standpoint. And most of the time, we're waiting on, if they request physician statement, we're waiting on the physician statement most of the time from the doctor's office. That's really what causes the thing to drag out, if it does, is the fact that we're waiting on someone else to get your medical records over there for underwriting evaluation.
And every solution's different as far as the underwriting goes. Some might just be a phone call, some might be full, and they might get all the medical records just to see a bigger story. We don't know. It will depend on each of you because you're all unique and might have different products.
That's a great example, because Scott just did an application. It doesn't happen very often, but he did the application. We did a tele-underwriting. They made one phone call to the client, comes back, we get preferred plus rating. I'm like, that doesn't happen very often. So we didn't even have to go through a physical or anything. The person got their policy in place, done. It was that quick. But we don't make that decision. The company and their underwriters will make that decision whether they're comfortable enough with just a simple telephone interview to issue the policy or not. If not, most of the time we prepare you to have a physical done. And the nurse obviously comes to you and does that. Takes 20, 30 minutes. Not a big deal.
The other part of that too is that you can apply for this thing, go through that underwriting before any money's transferred or spent, right? So you got to get the approval and the offer from the insurance company before that's done. So all thing you got is really your time.
That is a great point, because we can guess what the underwriting is going to be, but we don't make that decision. So we're not collecting any premiums with that. We want to see what your underwriting actually comes back at. Then we can designate what the cost of the plan is going to look like. Then we run the analysis. We put it in your financial plan to see if it's affordable and whether it works. And that's how we evaluate it.
This is something that you want to do longer term, but it's not something that you want to do for a couple of years and then bail on it. And it's just that you wasted your time and money doing it, right?
Right.
So that's what we were saying. When we put it in the plan, we got to make sure the plan is able to support it and pay for it. If you want it there, so when you apply it, that's when you're going to use it, right? So.
And I'm working on a case right now where the client has come back to me and says, well, we just feel like it's too expensive. It's going to take me about 15 minutes to prove that it's not, and it's something that needs to be done, and they can afford it, and they need to get it in place. Because if they don't do it, that's their decision. But Brandon and I, part of our fiduciary responsibility, being certified financial planners, we're going to document it, because Junior is going to come back to us and say, why didn't you talk to my parents about long-term care? And we're going to say, yes, we did, and we talked to them on this specific day. So we know what you need, but we can't make you do it. You've got to make the right decision that feels good to you.
Yes, ma'am.
Is there any reason why anybody would do traditional then?
Traditional is still a great way to find a plan, but it's very little. We see very little, because I think where we see the differences is people buy that if they really, really, really think they're going to need it.
Yeah.
And from a cash flow perspective, it's cheaper. But I'll be honest, 99% of the policies I see, maybe even 99.5%, are the other. You pay a little bit more for the guarantees.
Like Alicia had mentioned earlier, if you've got older legacy policies where you're the traditional, where you're just paying a premium for a certain amount of benefit per day, that's perfectly fine. And honestly, the older policies are pretty affordable. We don't want to replace those, but we might come back with a second policy to stack on a shortfall if we recognize it. That's how we can utilize it and basically make sure that you've got your liabilities covered as much as possible.
Yeah, it's hard to replace the old ones, but what I have seen is for those that get huge rate increases, and it just really, they're like, I'm done. We don't get rid of it. Maybe reduce it and layer on.
The highest I've seen is about 168% increase.
That's a lot.
So, it's not a conversation that Brandon and I want to have with our clients. Just to let you know, your premium's going up 168%. That's not a
They don't
good.
have like caps on it like they do with.
If the states approve it, it's good to go. I've never seen them. Pretty much it goes through and they'll spread it out over a 3 to 5 year period of time.
So you don't catch it.
They don't do it all at once, but they'll do it over a 3 to 5 year period of time. But it normally goes through. And it's not a comfortable conversation, but you don't want to get rid of those older policies. Those older policies are pretty powerful. It's just the simple fact that life insurance companies can't keep up with the long-term care companies have had difficulty over the years keeping up with the cost of health care. That's a big deal.
So the reason that those rate increases happen, just to give you a little bit of background, so I've been in the business for 27 years, and that used to be the only thing that we sold was traditional, and it was just a perfect environment. The rates were high, so they priced it based on the interest rates, and then they also priced it based off persistency, meaning how many people are going to keep their policies. Well, they assumed, the insurance companies did, that 10% would let their policies lapse. Well, in fact, it was a 98 persistency, meaning pretty much everybody kept their policies, and then interest rates bottomed out, so they were way underpriced. And that's why they've had to give these rate increases. They're still honoring their promises. In fact, Genworth, who's probably have the largest rate increases, they're the #1 payor of claims. But they have to do that in order to keep their promises to the policyholders. Whereas now, we've seen some rate stabilization, but there's still no guarantee that the newer policies can't go up, which is why we're seeing a lot of shift into these policies like that I showed you today. Yes, ma'am.
If you have a chronic illness, can you qualify for any of these?
Potentially, yes. These are a lot more liberal than your traditional long-term care insurance. Again, the first example I gave, you can have cancer, be receiving treatment together. So there really is, the underwriting is very different from carrier to carrier, and that's an analysis we would do to determine the right fit specifically for someone that has a chronic illness.
They've got a pre-qualification questionnaire that they run through internal underwriters before we even have to go to a specific company. So they'll do a high-level check on it first. Even though we might think you qualify, we'll do that pre-qualification checklist, send it to their back office. They come back and say, okay, we got 3 companies we think will work. And then we choose the best out of the 3 to apply. Correct me if I'm wrong. When we bring a case to you, when we do that route, the paramed, medical records, everything come to your back office, right? At FIG, or is it going to the company?
It depends. It goes to, so sometimes we do, if we're writing a life insurance policy,
Right.
we can get the medical records, review them, but long-term care companies don't do what's called trial applications. So we do the heavy lifting in front, so that's why we require as much information from you as we can before we even submit it. So the answer really is no.
Correct, and that's what I was looking for.
Yeah.
So when we go through this pre-qualification, they're really coming to us with 3 companies maybe, but they're going to tell us which one's the best. The one that's the best is the one we're going to apply with. And if it comes back and you get approved, then great, we got a decision to make. But if it comes back and you get denied or rated up in some form, well, then that's a conversation we can have to potentially make it work or not. Just like she mentioned, we've got several clients that have had cancer in the past that actually got it issued, and it surprised us. But when we ran the numbers within the plan, it made sense to put that money out there to get the plan in place because it worked within their financial plan. So we got to know the cost too, so we can put it into plan and test it. Because if it doesn't work, we're going to come back to you and say, you know what, we tried, and it just didn't work. So we're going to do that analysis for you.
So when it comes to the caregivers that you can, I'm assuming they've got to be licensed, and because I know my daughter's a CNA, and so I would want her, but I've heard that you can't hire your family.
So that's a great question. So what she asked for those in the back is who can provide the care. So it depends. That's a double-edged sword. So there's two types of policies. There's reimbursement policies and there's what's called indemnity policies. Reimbursement, historically, unless it has an informal caregiver written into the language, it's got to be a certified caregiver. Okay, so that means that, yes, potentially she could, but most policies, unless it's an indemnity, don't want family to take care of you. So on the flip side, the cash indemnity plans, if you have a $6,000 a month benefit, they send you $6,000 and you do whatever you want with it. So if you wanted your daughter to take care of you, you would probably want the more flexible option, which is the cash indemnity policy.
Are those more expensive?
No, not necessarily. And one of the ones with the lifetime benefits, theirs used to be a 100% reimbursement. Well, things are changing. We don't know what caregivers are going to look like. So now you can get up to 80% of their benefit in cash the first 2 years, which is when you're in the home, right? You usually graduate into facilities. You usually don't start there. So in that case, you have the flexibility to still be able to use your daughter. So if that's an important thing to you, that's what we would discuss with these guys. And when we do our heavy lifting, we're going to make sure to get you in the right product based on who you want to take care of. That was a great question.
When you talk about the life insurance or the hybrid plans, utilizing a life insurance policy, those policies, most of them, again, correct me if I'm wrong, the ones that we look at, most of them have an indemnity benefit rather than a reimbursement.
Correct.
So if we're able to take $10,000 a month out of a life plan and you want to pay Sally, your daughter, or whatever it happens to be that caregiver, that $10,000 after you're approved comes in, you can use it for what you want to at that point. And we've done that. We've had patients that we pulled the money out of in a lump sum. They didn't use it for long-term care. They used it for travel. Mm-hmm. And the reason is because the diagnosis was probably not a long-term diagnosis. So we were able to give them money that didn't even require tapping their retirement funds to make sure that they got some quality family time. And that was a huge benefit for us, but also a huge benefit for them because we didn't have to put the stress of pulling money out from retirement funds in order to fund that. And it was tax-free, by the way. So now you understand again why we work with Alicia. There's just so many opportunities and differences that you can apply here. Nobody's got the right answer. We need to look at your specific case and get it over to her. Okay? Thank you.
Thank you.
Appreciate it.